Hi there, my name is Jordan Lee and I'm a mortgage lender based out of Portland, Oregon. With today's video, I wanted to explore the factors that impact the pricing of your mortgage insurance, as well as go over a couple of different scenarios for structuring your mortgage insurance on a conventional loan. First of all, what is private mortgage insurance, or PMI, you might ask? So this is from the Consumer Finance Bureau, which is a great resource, by the way. If you're putting less than 20% down on a loan, you're going to be required to pay mortgage insurance, and it doesn't protect you, it protects the lender in the event that you stop making payment. So there are four main factors that impact the pricing of your mortgage insurance. One is your program, whether it's governmental like USDA, VA, FHA, or conventional. The second is credit score. The third is loan to value ratio, or the amount of down payment you're putting in. And the fourth is debt to income ratio, or how much your monthly payment, including your mortgage and your liabilities, is versus your gross monthly income. And on conventional loans, you can decide to pay your mortgage insurance monthly or increase your closing costs and pay for it up front. As we break down the numbers here, I'm going to focus on factors number 2 and 3, credit score and loan to value. So starting from left to right here, I have four scenarios. The first one is 5%, the second two are 10% down, and the fourth one is 15% down. So in all these scenarios, your interest rate or your note rate is going to be the same, except the scenario where you have a lower 680 FICO score. What does vary, of course, is the loan amount as well as the price of mortgage insurance. So to demonstrate how down payment affects your mortgage insurance pricing, you can see the difference between 5% down and 10% down. Even though in both these scenarios you have a 740 FICO score, the difference of monthly payment in that mortgage insurance is about $40. Or you could think about it like this. In a 5% scenario, it's an addition of 0.49% to your rate, and in the 10% scenario, it's about a 0.36% addition to your monthly rate. Annual rate. Now, when I'm comparing FICO score, so in these two 10% down scenarios, one of the FICO scores is 740 and the other is 680, and you can see that the pricing of mortgage insurance is almost a difference of $100 just based on that FICO score difference. Or, taken in the other way, you can look at a difference in annual rate of 0.36 versus 0.73 based on a 60-point difference in FICO score. And in this final column over here, 15% down, you can see the mortgage insurance is relatively affordable, or an addition to your rate of 0.17% annually. And oftentimes, clients who are very concerned about mortgage insurance, when they see the actual price of it, it makes them feel a little bit better than having to make that extra push to get to that 20% down mark. In this 15% down scenario, if you wanted to pay your mortgage insurance premium up front, you could do so, and it would cost you about $1,700, or about 0.6% of the loan amount. And then you wouldn't have to be paying it monthly. When you're getting a mortgage, make sure you reach out to someone who can explain to you the differences in short-term and long-term costs when structuring your mortgage insurance. And if you have any questions at all about mortgage insurance programs or getting rid of your mortgage insurance, which actually can be done sometimes without refinancing, please don't hesitate to reach out. My number and info are in the comments below.